closing it out in such a way that the HLP pool profited after being in a horrific position is the part that's a little bit confusing, because when anybody profits in a perp market, somebody else has lost. And I think this is a very clear example of the Hyperliquid team / validators choosing an incorrect winner and an incorrect loser in this situation.
Not a dividend.
It's a tale of two clans.
Now, your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Unnamed trading firms who are very involved.
I like that ETH is the ultimate Ponzi.
DeFi protocols are the antidote to this problem.
Hello, everyone. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intros. First, we got Tom, the DeFi maven and master of memes.
Hello, everyone.
Next, we got Robert, the crypto connoisseur and czar of Superstate.
Good afternoon, everybody.
Next, we've got Tarun, the Giga Brain and Grand Poobah at Gauntlet.
Yo.
And finally, I'm Hasib, the head hype man at Dragonfly. So we're early stage investors in crypto, but I want to caveat that nothing we say here is investment advice, legal advice, or even life advice. Please see choppingblock.xyz for more disclosures. So we finally had a relatively quiet week. Markets are not gyrating horrendously in one direction or another, but there have been some individual markets or marketplaces that have been seeing a lot of activity. So one of the biggest stories of the week has been this drama playing out on Hyperliquid. So for those of you not familiar, Hyperliquid is the new hot DEX. They are now the #1 DEX by overall volume. They are a huge perps exchange. They had a massive airdrop. They've been kind of a darling of crypto retail because of the size of their airdrop and because of the fact that it was fair launched. Now, there was a massive attack that took place over the last couple of days against Hyperliquid. And I'm going to try to describe the attack, although it may be difficult to follow some of the details. But it centers around a meme coin that we mentioned previously on the show called JELLYJELLY. So you don't even know the backstory of JELLYJELLY, but you do need to know that it's a very low liquidity meme coin that's very much past its prime. So JELLYJELLY was listed as a perp on Hyperliquid. So what happened was that there was a trader who opened an $8 million short on JELLYJELLY. Now this was, I believe, something like 50% of the circulating market cap at the time of JELLYJELLY, meaning that this was a massive short position that they opened against this asset. Now, what the trader did is they went off of Hyperliquid and pumped the spot price of JELLYJELLY, causing themselves to get liquidated. Now, why would the trader do this? Why would they force their own liquidation? Well, what happens is that on Hyperliquid, when a position cannot get liquidated in an orderly way, HLP, which is Hyperliquid's basically crowd-funded market maker. That's kind of the easiest way to think about what HLP is. It has a bunch of retail deposits. It's very fundamental to Hyperliquid's liquidity. Always being a very liquid market is because HLP is always there providing liquidity to traders. So HLP, when a liquidation happens in a very presumably disorderly way, HLP takes on the position and tries to liquidate that position in an orderly way. Now, this position was so big that HLP was now in a position to be short JELLYJELLY with no way to really get out of the short. There weren't people willing to take that short position or to go long and offload that short. And what happened was that then there was a short squeeze. Now the short squeeze was not just retail deciding, looks like Hyperliquid is stuck in the short. Let's screw them over. There were two other parties that entered into the short implicitly, and those two other parties were OKX and Binance. Because what happened was that the moment that people realized, oh shit, Hyperliquid as a protocol, or HLP, which is kind of implicitly backed by Hyperliquid, is now massively short JELLYJELLY, OKX and Binance announced that they were listing JELLYJELLY perps basically within 24 hours. Now this, almost everybody assumed like, oh my God, this is now exchange warfare. CZ and Star at OKX have basically pointed their guns at Hyperliquid and have decided this is our opportunity to take them down. Now, what happened next was, instead of Hyperliquid eating the loss, or retail investors on Hyperliquid eating the loss through their positions in HLP, instead, Hyperliquid validators voted to delist JELLYJELLY and manually close out the position at an Oracle price that was not the real price.
Below,
at the time that the position got closed.
Yes, the Oracle price was below even like the starting of this fiasco price.
Exactly. So Hyperliquid decided, you know what? These guys who shorted us and all the people doing this are bad actors. And instead of eating the loss or having the HLP holders eat the loss. Instead, we are going to artificially close out the price at a fake price, not the correct price, to make sure that HLP users are made whole. So that was more or less the end to the drama, but it has caused an enormous amount of conversation. So one, it dropped the price of Hyperliquid by quite a bit. I think it's down to something like $15. It started the day at something like $21. So it dropped something like 25% in a single day as a result of all this whole debacle. But it's caused a lot of people to debate. First of all, what should Hyperliquid have done in this situation? What was the core mistake that they got wrong? And second, does this mean that, well, how could they have done this without showing their hand that maybe Hyperliquid isn't as decentralized as it was once claimed to be, or maybe isn't as fair as it was once claimed to be? So you've got a lot of people on different sides kind of throwing mud at each other. You've got some people at centralized exchanges like BitGet calling out what's going on in Hyperliquid. Same thing, OKX called out Hyperliquid as what they were doing was somehow unfair. So it now feels suddenly very PvP, feels like the centralized exchanges versus the decentralized exchange, and kind of a watershed moment in the exchange wars now extending to DeFi. So curious to get your guys' reactions. Tarun, why don't you start? What's your take on this whole HLP drama? Help contextualize it for us.
Yeah, I mean, I think there is sort of like a sense in which these types of protocols have some certain types of deficiencies, in the sense that, like, a little bit like an AMM, like being an AMM LP, you can't reject orders. Like the naive Uniswap V2, even V3 to some extent. There's no real notion of I can reject an order without me going and pulling my liquidity. There's not like a way of saying I want to pick one order to trade against and not other orders. And I think you inherently have the same thing in these pools. The difference I would say between sort of HLP and sort of its predecessors in GLP from GMX and JLP from Jupiter is that the Hyperliquid balances, so it's you deposit, say, ETH into the pool. Hyperliquid will take your ETH and market make on many different assets. So maybe it'll take 1% of that ETH and market make on Jelly. It'll take 90% market make on ETH. It'll take the remaining and market make on BTC. That algorithm for choosing that is completely off-chain, and you're trusting the single whitelisted manager for that. So there's a sense in which the pool is not really trustless already. You're kind of trusting effectively the Hyperliquid team who is doing the allocation rule. So I think clearly there is, and they've written tweets about this, so I'm not going to belabor this, but there clearly were a lot of mistakes they made on their side in terms of how their strategy was working and how they didn't have position limits and cap sizes and OI limits and all sorts of stuff like that that could have ameliorated this without the emergency price. So let's just say I think they learned a lesson about sort of the mechanism design aspect. That's the first, that's the only concrete thing that has been said that they will fix after this incident. So let's start with that.
Sorry, the thing they'll fix is open interest limits per asset?
Open interest
what
limits,
exactly
and then concentration limits, and
for HLP or for the actual underlying
for
exchange?
the types of positions HLP will liquidate.
Oh, I see.
Right.
So now in the future, HLP won't even touch something as Jelly Jelly.
This is why when I started describing this, I described liquidity pools that don't discriminate, right? You can't say I don't want this order and I want this other type of order. And basically, if they had a way of having HLP discriminate versus third-party open liquidation, then the market could have priced what the value of that position is, and HLP didn't have to eat the loss. But the way it's constructed right now is it does just automatically trade against it, like a Uniswap pool in that sense for the HLP liquidator pool. So there's a sense in which they didn't put many restraints on the strategy. The strategy was just kind of and you don't, it's that strategy is run by the Hyperliquid team off chain somewhere. So it's not I know what the code looks like. I mean, most of their code is not open source, right? I can run a node, but I only get the binary, and there's a lot of stuff that's is not clear about how the setup works. And so I think this was a very clear thing where they made mistakes on their strategy limits. And I think that's the first thing they said they're rectifying to clear up. But to the rest of the market, I think it sort of does exemplify the value of having that strategy at least somewhat more open than the way it is right now. Because clearly you have no transparency into the fact that, like you as a hyper HLP depositor, you don't actually know if there is some risk limit that HLP will automatically take an entire pool position or not. You also don't know if they'll like devalue the oracle the way they did. And there is one note in the docs that tells you this, but the code's not open source, so you can't really you don't have any, even if it's not open source, there's no like verifiable proof that it's doing this. So I would say, yeah, the guarantees they gave you were sort of different than what people I think may have thought they were getting in other protocols where you do actually see what the strategy is doing. There's trade-offs, right? When you don't have a public strategy, you can be more capital efficient. So like, it's not like there's I'm not trying to vilify. I'm just saying there's a kind of like a decision space, trade-off space, and they clearly made some wrong decisions that they're rectifying. But I think,
one of the big questions that I saw, Kevin Joe wrote a great tweet thread about this from Galois. He was the guy who famously shorted Terra at the top. One big question I have is like, do you think it made sense to bail out the HLP depositors? Right. So obviously the HLP would have had pretty significant losses.
No.
You think it was a mistake?
No, I think this was the cardinal mistake, frankly. I think resolving a market after messing up, we'll call it the risk parameters of the platform, that's one thing. I think closing it out in such a way that the HLP pool profited after being in a horrific position is the part that's a little bit confusing, because when anybody profits in a perp market, somebody else has lost. And I think this is a very clear example of the Hyperliquid team / validators choosing an incorrect winner and an incorrect loser in this situation. And frankly, the HLP liquidity providers who are backing this, platform market maker that takes on positions are entering into a risky proposition. If the liquidations are successful, they will make money. If they are unsuccessful, they will lose money. On the other side of them, in this example, when closing out the market, are all of the people that were participants in the perp market normally, the people that happened to be long, for instance, the people that happened to be short. And the HLP product, combined with the price that it was closed out at, somehow HLP was up, which means that somebody else was down. And in this situation, I think that's inverted. I think that, the whole system would have been better off had they not done it in a way in which they profited, so to speak, and the user base as a whole lost, so to speak. If you're gonna pick a price and rig it, don't pick one that's favoring yourself. Like, honestly, they picked a crazy price, and not only that, it was extra crazy because it was lower than where the fiasco even started. It's like they chose to just give themselves a winner,
Yeah, I agree with that. I mean, I think it kind of goes back to this weird, I think, tension between like HLP as a product versus Hyperliquid as a product. Because HLP is not the only vault, right? There are other vaults people deposit into that run other off-chain strategies. And I think the perception and presentation of HLP is like, hey, this is our, first party vault product, but anyone can run a vault. And I don't think anyone assumed there's any sort of privileged access that HLP would have. I think people online compared kind of with the saga to loss socializing or auto deleveraging that has happened in other perp exchanges in the past, where hey, this market overall, is below margin, and so we're going to freeze positions and sort of socialize, losses are tapped into the insurance fund. This is not that. This just happened to be HLP was in loss, but Hyperliquid itself was not at risk of default, and so it's like. And I think it creates this weird perception where it's like, why is HLP a favored liquidity provider on this exchange? Where if they have a bad trade, they get bailed out. Like, what do other market makers think? What do other vault owners think?
Bailed out at a profit. It's crazy.
It's insane.
Bailed out by a profit by hype, not HLP holder denominated Oracle manipulation. That's the other weird thing, right? It's like. The hype holders voted to give the HLP holders this profit.
Well, can you be specific? I mean, what's the exact mechanism by which the hype holders are participating in the validation of Hyperliquid? Because I don't know the details of how the validation.
I mean,
you can delegate to a validator and but some of them get the KYC sometimes, so it's kind of still a little opaque. But Tarun's right; you could get a binary.
They control the Oracle, so that they chose the governance vote chose the Oracle price. So the hype token holders effectively voted.
Indirectly voted through validation.
Well, they voted via governance to reduce the market and then choose an Oracle price, right?
Yeah, there's a lot of criticism because the fact that the foundation itself runs, basically they're delegated a supermajority of the total hype tokens. So, the hype holders are voting through delegation, but of course, this whole thing happened in about 2 minutes. So, the beginning of the vote to the end of the vote was not enough time for voters, quote unquote, to actually be able to have a say.
Okay, so one more question, taking this back to ground floor, education. Let's go back to the original, this is an attacks type situation where two exchanges that were not Hyperliquid listed perps at the same time. I don't necessarily agree with the hypothesis that other exchanges listing perp markets would have an impact on Hyperliquid necessarily. And I'm still a little bit confused by this narrative as to what the sort of sequence of impact is, because, the perp markets themselves are just another trading venue that is detached from the spot market, right? And even if there's excess demand on a new Binance JELLYJELLY perp, on the long side, it's not necessarily going to change the price on Hyperliquid or in the actual underlying spot market, which is the index to control the funding rate on Hyperliquid. They seem detached to me. What's the sort of mechanism of transference?
I mean, so the first thing, of course, that if you're Binance, you need actual spot inventory, and it just takes longer to go source that, right?
But they opened a perp market. Inventory. They didn't open a spot market. They had
no. That's what I'm saying. It's faster to launch a perp market than to launch a spot market, because for the perp market, you don't have to actually get the inventory onto your platform. So somebody has to be figuring out how to get that inventory to where it needs to go to get to basically move the spot price and get it in line with the index, right? But you don't have to worry about that if you're just listing perps. If you're just listing perps, all you need is enough demand for people to go and trade the perps. So structurally,
and for every long there's a short. For every long there's a short.
That's right. But structurally, it's simpler to rate. It's if you're like, hey, I want to kill shot these guys as fast as possible, and there's a limited time to do that. What's the fastest way to get there? The answer very clearly is perps, not spot. So
no, but this how is it a kill shot? That's the part I'm still grasping at and don't fully
because it gives more people
access
to participate in the short squeeze. Right? If Hyperliquid is getting short squeezed, and the goal is look,
but for everyone who's longing it on Binance, there's someone shorting it on Binance too, and they are short. It's not
Well, that's not true, right? It depends on the funding rate dynamics, and the funding rate did blow out.
If the funding rate goes to zero, then yes.
But the funding rate blew out. The funding rate blew out. It went up 300% in 1 hour, right? So the funding rate was very out of whack from that.
But that's fine. That's less than 1% a day, right? And when
right.
this thing's
That's
moving
exactly
hundreds of percent,
it's a crazy short squeeze, right? Exactly. So this is something that markets are expecting will be over. I'm sure they will delist JELLYJELLY perps within a week or two, because obviously there's not real demand for JELLYJELLY. There's only
no
demand
matter what Sam
event.
Lesson says, no one wants JELLYJELLY.
But the interesting thing about this thing, okay, so again, it might be difficult to follow the mechanics here if you're not familiar with perps and you're not familiar with, liquidity providers and HLPs and all this stuff. So let's abstract all that away, right? Fundamentally, what happened was that Hyperliquid was stuck with a toxic position, and two other exchanges, Binance and OKX, jumped onto this to try to further bleed out Hyperliquid. Right, and basically to try to force HLP, not Hyperliquid itself, but force HLP to become insolvent. Now, this is kind of a crazy move, right? Some people were saying oh, this is kind of like CZ, what CZ did with FTX, which I don't think is true. I don't think CZ had good reason to believe that FTX was going to become insolvent by dumping FTT. And if you look, for example, at what happened with the Binance hack, the Bybit hack. With the Bybit hack, actually Binance and BitGet came to Bybit's defense, and they actually lent Bybit Ether in order to help them fulfill the shortfall and to like maintain exchange operations, right? So what you see is actually the total opposite behavior that they were doing just a few weeks ago with the Bybit hack compared to what they're doing now with what's happening with Hyperliquid. So I don't know if there's a good theory that explains why they chose to go this way, but it seems like, and this is what Kevin Joe was saying, Hyperliquid has implicitly said now through this behavior that there's a put on HLP. There's a Hyperliquid put. If HLP loses too much money, Hyperliquid is going to come in and defend it. And you can see that the Hyperliquid price moved really dramatically in response to what's going on with HLP, which to me was kind of confusing because I'm like, why? What's the connection here between HLP and the value of Hyperliquid? And maybe there's something I'm missing with respect to the tokenomics of HLP.
HLP doesn't really have any tokenomics. It's like an LP pool.
It's not tied. Okay, yeah, so it's not tied to the hype price.
No.
Yeah.
That's purely. I think the weird thing here, and this is maybe a better way of viewing this, is like I view the HLP pool as like a company having debt, right? Because it's like I raised money from depositors to go lend.
But it's not debt; it's equity.
No. Hype is equity. That's the weird part about this.
No. But I'm saying it's equity in the market maker, right? Because the pool investors take all the profits. It's not debt.
Sort of, yes. The market maker is taking the user's USDC and using it to trade all of the different markets on Hype.
That's right. But the users get all the profits, right? So it's not debt.
Yeah, I think the reason why Hype dumped is I think it sours the future of the exchange. Like why would you want to trade on an exchange where you know there is a privileged LP that can't lose? Like why would you want to provide liquidity there? I mean, this is sort of again the same things that come up when exchanges have in-house market makers is like, okay, well, how far does this privilege kind of go? I think for
there is one very cynical take that I think a lot of people have had, which is like the majority of the HLP liquidity is from the Hyperliquid team themselves. So like they didn't want to take that loss.
No, there's like $500 million in there.
No, it was like 200 at the time. Yeah.
Oh, sorry.
So I could easily, like when they bootstrapped the pool, it had over 75. So it's like, it could be a large majority of that 200 was theirs.
But still, wouldn't their balance of Hype be so much larger than
For sure.
HLP
But here's another reason you should be thinking of the HLP pool as a debt, more debt-like instrument is that it takes money from depositors who are supplying, and you can think of it as like lending to each market that it's kind of market making in. So it's doing kind of this like local loan. And in the case of like Jupiter and GLP, they are explicitly lending protocols. They like charge fees in that way. In the Hype case, they charge a fee plus the spread effectively. And the idea is like if it defaults, like in this case, then it like, the depositors have first right rules. It's almost, that's why I say it's like debt holders and equity. They actually can claim the collateral. It's not like equity and they get zeroed out. And so I feel like it's like some weird in the middle, but like I think it's closer to debt. And Hype is the real equity because Hype is the thing that's like able to really control. I mean, the thing that can control the Oracle is the equity instrument in my opinion.
Well, so I the way that I would frame it more is that like Hyperliquid is almost like an exchange that's B-booking, but the B-book stuff is happening through HLP. HLP is the equity in the B-book, and Hype is the equity in the exchange itself.
Can I make just a very controversial statement real quick?
Go for it.
I feel like we should have learned after FTX that an exchange and a hedge fund like thing where a proprietary market maker trading on the exchange should be separated, right? One of the
separated.
I mean,
to the credit of this though, I can see every single trade I can see every single trade Hype HLP is doing. I can withdraw whenever I want. Like it is very different.
I agree with that. I think actually in principle what they're doing is totally fine.
It's still their team running the market
attached at the hip.
They are attached to the hip.
No. That's not what I mean. What I mean is that if the exchange is putting a put on this market maker and saying this market maker cannot lose money, now they're joined at the hip, right? Just the team running the market maker itself, it's like, well, if you don't believe in this team being good at running a market maker, don't buy equity in the market maker, fine. That's not a problem.
And that's how it was presented. It's like, hey, come spin up your vault, and here's another market maker that you can deposit into. And it's like, we are one of many. And actually, no, this is a one of one.
I will say that if you look at their other market makers, my favorite one to look at is Sifu, who just constantly loses money. Like, I don't understand why people keep giving that guy money. He's historically lost money, forever.
I think he's up today, right? Or maybe up this week.
Beautiful.
His vault is very funny to watch. But my point is, there's a lot of adverse selection already in those vaults that I think intuitively these two things were separated until this event, and now they're not viewed as separate, right? And
I don't think they were separated even prior to that. Prior to the event, the team was running a market maker that was the primary market maker on the platform. Yes, the economics were owned by users and not them, but it was the same owners of the trading venue running the primary market maker, trading on the trading venue, and being the liquidation mechanism.
Yeah, I mean, obviously them being tied into the liquidation mechanism does make them somewhat privileged. But although in some ways it makes them unprivileged, right? Because they're forced to take on these positions that a market maker might not want to be taking on all of these.
Totally, but Alameda, whether they wanted to or not, took on all the bad positions on FTX with the mobile coin and all these horrible things that blew up their exchange as well, right? They were forced into it. It was both a blessing and a curse.
But the whole idea of why this is potentially okay is that even if HLP goes to zero, takes on a bad liquidation, gets completely fucked, the retail users are taking the risk. Not retail users, let's say investors in HLP are taking the risk, and Hyperliquid can continue on even if HLP gets zeroed out, right? That should be how it works. If it's not how it works and it's all commingled, then I think this whole structure no longer really makes sense, right?
But by the way, from a vibe standpoint, just like aesthetically, I think getting seppuku'd by mobile coin is a better aesthetic than getting seppuku'd by JELLYJELLY. Like JELLYJELLY is just like an embarrassing excuse of a VC meme coin. And mobile coin, there are lots of negative things you can say, but at least it has a network. Like there was something that was built versus like this dog shit piece of shit coin that was like some VC who was too bored decided to try to dump on retail. Like
I agree. MobileCoin was trying to be a real project versus just an outright.
Yeah. So anyway, sorry. Well, it's more like, aesthetically, if you got killed by MobileCoin, there's like a little bit. It feels a little like okay, that's like an honorable.
But it's sort of like it could have been anyone. They just like found JELLYJELLY.
I get that. I'm just saying aesthetically,
like an object
not
on the ground
financially.
That they sharpened into a knife and then stabbed Hyperliquid with.
I'm just saying aesthetically, not
sure, aesthetically, yes. Yeah. Okay. So one of the points that Kevin Joe made as well is that in the wake of this, what you should expect to see now is that let's assume that HLP and Hyperliquid are now tied at the hip, whether they acknowledge it or not. What that's likely to mean is that one, third-party market makers or liquidity providers are likely to do less on Hyperliquid because they know now that they're not fighting on an even playing field with HLP. Second, HLP.
To be fair, most market makers I talked to already said that. So I think it's not like they didn't know that, but now they get to use it more as a real excuse.
Sure. Second is that you should see more capital going into HLP because people now realize that hey, the protocol is going to protect you.
Disagree. Right? Less. No. You see the flaws in.
Wait, can we bet some Red Bull?
Good idea.
This is like a Red Bull case bet. I feel like.
But I think because the problem is that we don't know in absolute terms will it go up because it depends on Hyperliquid itself.
Let's go right now on DeFi Llama. It's we'll just use DeFi Llama just as a.
What's happened to the vault? Has it gone up or gone down?
It's gone down.
Down.
Okay.
It's at 185 million. It was 3 days ago at 296 million. 299. Let's say it was 300 million on March 24th. I think that's a good benchmark time.
Okay.
It's down to 185. I think I could see both points. I actually wouldn't be able to pick one because it's possible that it goes up like the way Hasib is saying because it's like it's viewed as a FDIC insured product or something, But there's also the fact that the fees on the exchange might go down because of this, because there's a loss of confidence, and so then the fees it could make go down. So then you know what I mean? Those are two countervailing things, and I don't know which one will dominate.
I actually think the risks have gone up, and yes, if the incident is bad enough, then the platform steps in and closes the market and uses a resolution price such that HLP doesn't lose. We just saw that with Jelly Jelly, right? There is a put, fine. There might be a put when things are really bad, but the Jelly Jelly incident has exposed the fact that small cap assets on Hyperliquid are easily exploited under the current mechanisms. And the probability of a repeat incident has gone up like at least an order of magnitude. And if I were looking at HLP,
I totally disagree with that. Now nobody's going to try this again.
You guys are like this is like trying to fight over whether like an airline that just had a plane crash is more safe or not.
Well, they are also materially changing, obviously, HLP strategy in the exchange, right? To like limit OI. So it's not like, it's, these are not totally independent events.
Yeah.
I know, but again, this is also not the first plane crash. There was a plane crash like 2 weeks ago, the exact same thing, where there was a intentional liquidation in the Bitcoin market, which is not a small cap asset, which is a very large cap asset. And the exact same, we'll call it attack parameters, took place like 2 weeks ago.
I think you guys should bet. Just saying.
Well, you're not betting?
I already told you. I'm kind of like I'm in martingale. I don't think I have a decision on which one it is.
All right, what's our time frame? 30 days? A year?
No, let's say end of the year. End of the year.
And the end of the year. Yeah.
End of the year. More deposits or fewer deposits in HLP?
I think you do HLP as a percentage of OI because the exchange OI might go down, deposits might go down. Yeah,
that's a better metric. That's a better metric.
Right,
I don't know what it is right now though.
Okay, I say down.
I can find that.
I say down.
You say it goes down. I say definitely goes up. Definitely goes up. Okay. So what are we betting? One case of sugar-free Red Bull?
Hyperliquid.
Okay. All right. We'll figure this out. We'll publish it alongside the episode of what the current number is, and we'll see at the end of the year.
Total open interest as of yesterday was 3 billion. And yesterday it was at 236 million. So
but we want today.
So
like,
7%.
Like
the ratio of HLP to OI is 7.6%.
Right, but the OI dropped a lot since yesterday.
The OI dropped.
Oh, sorry, not the OI. Not the OI. The
HLP dropped. HLP. But OI dropped about 10% also.
Okay,
that's pretty close.
It's not like that. So
yeah.
So it's at like 7.6% now. Like the
all right.
The ratio.
So we'll lock in those numbers and we'll see at the end of the year if I'm right or if Robert's right. So I like this. Okay.
Wait. So did you guys pick who? Just so we have
I'm lower. Haseeb's higher.
Okay.
Yeah. That's
on the ratio of OI.
Sounds good. I'm going to pin this in our group chat so that we have a memory of the number.
Okay, good. Yeah, we'll send a reminder. Okay, let's talk about some more positive news. Let's talk about what's happening in our good friend Tarun's favorite field, DeSci. So big news in DeSci land, Say protocol, which is a high-performance layer 1 EVM chain, has announced that it is placing its boldest DeSci bet yet. The Say Foundation is exploring the acquisition of 23andMe, the genetics company that has famously filed for bankruptcy recently. And what they said was that they are going to defend the genetic privacy of 15 million Americans and ensure their data is protected for generations to come. They are going to deploy 23andMe on Say and return data ownership to users through encrypted confidential transfers, allowing users to choose how their data is monetized and to share in the revenue. This isn't just about saving a company. It's about building a future where your most personal data remains yours to control. Wow. Tarun, how can you argue against the magic of DeSci saving all of our genetic data?
Please prove to me that there's any bare modicum of understanding of any privacy preserving technology known by anyone who works at Say. Oh, I'm waiting. There isn't. If you told me like someone who's doing a real privacy thing bought it, it'd make way more sense. If you're telling me someone who's buying it and is like, we're going to somehow spend a lot of blockchain money and then maybe make it open in some weird way, that is almost worse than the people who are just buying it.
Okay,
to,
so
like,
what you're saying is that you
LLM.
support this if they do it right.
Yeah.
Sounds like maybe you should do some consulting with.
I think you should be an advisor.
I think you should be an advisor to this.
I think if you're going to do it and you're going because like all the other bidders in the current stuff right now are like all these comp bio. Okay, so I know a little bit about the bidding that's going on for 23andMe. Is a lot of the people who are lining up are like computational biology companies, like AI drug discovery companies who basically want to buy the data as like a training set. The reason there's this uproar is that people are like, I bought 23andMe 8 years ago, and like their privacy policy then said they were not going to share it with anyone, and they went bankrupt, and now they're sharing it with like people who are who maybe will make like some blockbuster drug out of my data, and I didn't consent to that. Which is fine. So like there's two aspects there. One aspect is the privacy aspect, right? Like the terms of service that you initially signed, which are now null because the company went bankrupt, on privacy are not there. But secondly, the kind of terms of service on monetization aren't there. And I think if you're someone like...
Wait, is that right? Like the terms of through which you bought a thing get terminated because the company went bankrupt? Because they're Chapter 11.
What entity enforces those afterwards, right? I thought there's like a... If they come out of
Chapter 11, they're doing a restructuring. They're not like liquidating the company.
Yeah, okay, this is a good question. I kind of assumed that's what people are yelling about.
If only we had a guest who was like a bankruptcy lawyer or something.
Yeah, exactly. That's
all right, well, that's not okay. Yeah, screw that.
Okay, the main things people care about in the terms of service are the privacy aspect and monetization aspect, right? Like they kind of like those were the two things. And all of the people trying to buy the company, there's like one set of people whose entire goal is pure monetization, right? Like the people who are these comp bio drug discovery companies. And then there's some people like nonprofits and stuff who are like trying to bid. And then of course there's the DeSci world.
And then there's say.
And I would say, no pun intended, that if the blockchain is supposed to help monetization, fine. That's like a 2017 ICO pitch. I'm excited to see that fail once more again. But if you said something about the privacy aspect, I'd be like, okay, that maybe you could actually be useful and like find a way of like doing this in a privacy preserving way, but still making it somewhat monetizable. But I think if you're just like, oh, we're going to like let you own your own data and monetize, I don't think I've seen anyone who's successfully been able to do that. It's a little bit like this thing Tom was complaining about earlier, right before the show, about like people complaining about the Studio Ghibli stuff because like people didn't monetize it on the blockchain or something. It's like that is like completely not the thing going on here.
That is very true. I also don't know how they would buy it because I think there's still like $200 million in debt. So unless they have some crazy structuring, or hey, maybe the 23andMe creditors want some say tokens, sweeten the deal a little bit.
Do some block tokens for creditors.
I mean, the thing is, all the other people bidding. So there's like some big companies bidding, but I actually feel like I have no clue their chance of winning. But I kind of get the feeling that sentiment wise, it's like people want it to go somewhere else, given the initial turmoil of the company. But yeah, I don't know, like. Make sure if you have a plan for like some preservation of the sense that the original terms of service had, then I think like sure, fine, go buy it. Go default your validators because you're basically borrowing against their future earnings. If you think about it.
At a high level, here's my take on this. Right now, all the data is in a database that's owned by a company that's bankrupt, right? In general, putting all the data on a blockchain can be no more private than it currently is, right? I think there's risks that putting all the data on chain, has more exposure for the information. Obviously, it comes down to what security measures are being taken, what encryption there is, what zero knowledge, whatever there is, blah, 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 blah. But I don't think it's going to improve privacy and security versus the status quo, which is there's a bankrupt company with a database full of info.
Well, seemingly right now, if what Tarun is saying is correct, it is true that, base case, some company acquires that database full of info and just does whatever the hell they want with it. So that's clearly not the optimal
Agreed. There
outcome.
could be worse outcomes. Agreed. There could be
definitely be worse outcomes.
Worse buyer who takes it
super complicated
and they publish it on the internet without any security standards, right?
Probably less likely, but yes, that's in principle possible.
It's in principle.
Yeah, I don't know. Like I've never bought this idea that like, okay, you know, sort of data ownership means that you take some data, you encrypt it, and you put it on the blockchain, and then you sell people. You know, if you want to use my data, here's the key to decrypt it. Like I've never seen how that solves anything.
It's also just like, I think, especially if you are blockchain people who don't understand the privacy side for doing that type of stuff correctly, there's so many ways you'll fuck it up and release everything. And I feel like that's more the thing I think is more likely to happen, is that they spend all this money, they accidentally release it in some weird way, and then like, I don't know, North Korea makes a super bug from training their bioweapon LLM.
Yeah. Okay. So what you're saying is that you're not bullish, Tarun.
I think if someone else was doing it, I'd be more bullish. But
if someone else were doing it, who has to do it for you to be bullish?
OpenAI,
XRP,
Microsoft.
I think someone who's doing more like
Pfizer
stuff. Actually
TE
weird,
stuff.
Like I actually sort of have this weird thing where actually like Nvidia using this to prove their privacy preserving H800 stuff that it works is like kind of a good way. It's a way for them to have a data set that's unique to their chips that you can't see the whole data set, but you can do queries against it in their GPU. And like I feel like this is someone like that probably has more incentive to not just like completely fuck things up. So
okay, but nobody in crypto. You wouldn't trust anybody in crypto to do this and be a good.
What about the
steward
Ethereum
of
Foundation?
I think like people doing like low level cryptography, advanced cryptography stuff like ZK, T, FHE. I think all those people would be good, but like I don't think that they're gonna like figure out how to productionize it because they're already
sure. Fine. All right, let me ask you this. Putting this story aside, it's been I think 3 months now since you've declared war on DeSci. How is it going?
Since my war on DeSci, I mean, I don't know where's BioProtocol nowadays. I just kind of gave up because I was like, I'm kicking a dead cat. You know, it's like I think everyone kind of realized it's like mainly a
dead
scam.
Cat.
I don't know. 23andMe can bring it back.
I think it's mixing metaphors a little bit there.
It's mainly a scam. There are some well-meaning people who
just so you know, BioProtocol has 321 million FTV. That's pretty serious. That's worth more than 23andMe.
Don't give them any ideas, Haseeb.
I mean, the thing is, they'd have to emit more than they have currently unissued to get 23andMe.
My point is like, you know, I think people have realized like most of the hype at that time was like, it was just a meme coin that happened to have a different type of branding. It like attracted people who were like, meme coins are gross. Those are hype beasts. But DeSci is like donating to a nonprofit. I feel like a great meme coin holder. And like it attracts, that's like what I thought it was. It's kind of an affinity scam to kind of target people who are like, meme coins give me the ick. But like a meme coin that does social good. Oh, but I don't check how it does the social good. I can't even verify that it did. Oh, I'm trusting these random 5 DAO token holders. Okay, great, whatever, bye. You know, like that's kind of how 90% of DeSci is.
So you're just saying it was meme coins with better branding, or more
different branding. Like, you know, it's like targeted a different demographic, right? Like than the Solana degen stuff.
What was that Ohm fork from last cycle that was like, we're going to use the treasury to like plant trees?
Carbon credits? The carbon credit one, right?
Yeah, the carbon credit one.
Clima-DAO.
Yeah. That's right. Yeah.
Reincarnated.
Wait. Yeah. Can we look at the price of Clima-DAO? I had forgot that thing existed.
Yeah.
All right. 5 million market cap.
No. You're kidding. FTV?
FTV is 5.5.
I mean, it's really, this year it's down like 80% this year.
Huh.
I mean, this chart
I just checked.
Yeah.
So Ohm, like Olympus, like the OG Ohm is at 430 million market cap. It's up 100% this year.
Yeah, it's been up. They've been monetizing their treasury and like distributing yield. I feel like Ohm actually has some secret comeback story.
You think so?
Maybe on a future episode we'll have Ohm on.
because basically think about this. In the process, they raised a huge treasury, and then they started monetizing that treasury in DeFi as things went up, and then they're distributing some of the yield back. So it's like kind of a weird business.
So now they're like robber barons or something, where like the underlying business has disappeared, but they just have this foundation that continues on.
I think they're still building new products. So I'm not sure, but I know that there's now real yield coming in.
So they're like the new Gnosis.
Gnosis, Filecoin, I can think of all the ICO people who did similar things, right? Where they raised a huge ICO, then monetized the ICO very well. EOS, it changed their name. What is their name now? Volta?
Block One?
No. EOS, the chain changed its name to Volta.
Really?
Yes.
Yeah, yeah, I saw that. They did a whole rebrand.
Well, Block One, who made EOS and made all the money.
Why were there were a bunch of rebrands today, right? Like people were complaining on Twitter at Wintermute rebranded, someone else rebranded.
No, I thought the joke was Wintermute didn't
much of a rebrand. Yeah, exactly. What was the rebrand?
I didn't
they
see
just
it.
Made
I just
their
saw
logo like short, small green text. It's the same fucking thing.
Okay. Because I just saw Evgeny fighting haters in the replies somewhere you don't know the difference between a brand update and a rebrand or something, and I was like, what the fuck is happening here?
Hey, spring! It's spring. It's time for fresh coat of paint. I respect that. All right. Well, speaking of a fresh coat of paint, there is a new stablecoin bill now working its way through Congress. So before we mentioned the previous version of the stablecoin bill called the Genius Act, that was sponsored by Kirsten Gillibrand. We now have another one in the House instead of in the Senate called the Stable Act. Now, the Stable Act was introduced by French Hill. Yeah, go ahead.
Petition for prediction markets to bet on the names of these bills.
Well, I think it's somewhere between stable and genius. It's sort of stable genius, Oh,
that did not occur to me. Wow.
I didn't think about that.
What? You guys didn't realize that? The whole point is it's a play on Trump's quote about being, a stable genius.
No.
Yes.
Really?
Yes.
Again.
Wait, but which one came first?
No, originally
Genius
I
came
thought,
first.
Yeah, Genius came first, but I thought it was the Stable Genius Act. It was the very first iteration of the, backronym.
No. Are you making this up or did you actually hear this?
No, I'm serious.
So they were making fun of Trump?
No, it's not making fun. No, it's a celebration.
Well, I do not believe you. Where are you getting this?
I don't know. The internet?
This sounds like a wives' tale. This does not sound real. There's no way.
What? No, I mean...
Well, Robert was allegedly in DC, so, he's... I'm going to maybe trust him on this. But I actually don't see anything about this.
This sounds like DC hearsay. There's just no way. Because first the Genius Act came first, and it was... the previous version of this was not called the Stable Act. So I think it's a coincidence. I think it's totally a coincidence. There's no way that you would call it Stable Genius, because now that's like an insult. People use it to make fun of Trump.
Do they? I thought it was a celebration.
I think they're things that Trump himself, that other people think are insults. Yeah. He doesn't think they're insults. He's like Teflon. No. The Teflon Don thing is this.
Okay, well, regardless of whether or not Stable Genius is meant to be a joke. So anyway, this new bill is called the Stable Act. So just to give a sense of the differences between the Stable Act and the Genius Act, because we now have two versions of this bill. These two versions are going to be competing in the House and the Senate to get reconciled into one final bill that's going to eventually pass. And we don't know which pieces of which are going to end up making it into the final bill. So relative to the Genius Act, here are the big differences between the Genius Act and the Stable Act. So first and foremost, the Genius Act is probably more industry friendly. It's more flexible. It allows bank and non-bank stablecoin issuers alike. So you don't have to be a bank in order to issue a stablecoin. It allows for state regulators to oversee a stablecoin issuer rather than just federal regulators. And it has a big focus on interoperability. It allows you to pay yield potentially in some situations. It's basically just more encouraging the growth and creation of stablecoins. The Stable Act is more restrictive. Stable Act only allows the Fed to oversee stablecoin issuers. So you need direct Fed oversight. Only banks or approved bank subsidiaries are going to be allowed to issue stablecoins under the Stable Act. There's a much heavier compliance regime under the Stable Act, and the overall sense you're going to get is that no yield coming out of these stablecoins, a lot less creativity you can have around the types of assets that you have in reserves, and there's also going to be a 2-year moratorium on algorithmic stablecoins, although currently existing stablecoins are going to be grandfathered in. So that's the Stable Act. Robert, you said that you were on DC making the rounds, talking about stablecoin legislation. What's your sense of how this bill is being received, and how do you think about it?
Yeah, so I happened coincidentally, timing unrelated to, stablecoin legislation being top of everyone's mind. I had a trip to DC on Tuesday and Wednesday, had, about 15 meetings with members of the House. And obviously the number one conversation the whole time was on stablecoin legislation, just because it's so close. I think there's obviously a tremendous amount of excitement from both parties for creating legislation that's pro-crypto and non-controversial. And I think in a lot of ways, stablecoin legislation, everybody, both sides of the aisle, pro-tech, a little bit tech scared, realizes that we need to enshrine law around how stablecoins work. It's too important not to. And so I think there was a widespread consensus that stablecoin legislation would obviously be the first major crypto legislation that gets passed, because it's also relatively simple. We're talking about a couple differences between the House and Senate side that will get resolved, in the near future. There was obviously a lot of conversation about what comes after stablecoin legislation. I think there's a widespread consensus that it's market structure in some variety. And, I think it feels a little bit farther out. So most of the conversation and focus was really on stablecoin legislation. And, to reiterate, widespread support, and granted, I was talking to members that were in general, more aligned with crypto than skeptical of crypto. So there is some perspective bias in there, but, full support for stablecoin legislation and a widespread expectation that, any differences between the House and Senate would be easily reconciled.
I think the first time I ever heard the phrase narrow bank was 2009. I'm like, everyone and their mom has been talking about narrow bank legislation for okay, this makes me just sound like an old curmudgeon, but I'm like, everyone's talked about how you should have these kind of narrow banks that kind of very restrictive on the types of yield they can offer, but
So Drew, can you explain what a narrow bank is?
So I guess the original definition of narrow bank and the current definition deviate, so I'll give you sort of some intersection. Narrow banks, I think especially after the financial crisis, there was kind of this view of can you make banks, at that time there was hey, do you put a ton of regulations on banks to say okay, you can't trade or do these types of activities or whatever? Or do you try to also just make a completely separate bank for consumers that can only do very simple loans and deposits and does not really do much else? So it's a little, ironically, a lot of the early fintech apps and, currently Square Cash, Venmo, stuff like that, they sort of function as pseudo narrow banks where or N10 or in Europe and stuff like that, where you can deposit, but there's not many products you can earn. You can maybe buy treasuries indirectly, or in the case of Square, I guess Bitcoin. But there's not the principal who's holding the funds is allowed to really go and earn yield in very exotic ways. They can't have a prop trading desk. They can't have they can't buy weird bond portfolios. They're very restrictive. And in some sense, a lot of the stablecoin bill really reminds me of narrow banks. It's the no yield on stablecoins, the kind of how the bank charter is used. And it sort of feels to me it's kind of interesting. It's took all nearly 20 years from the first time this concept existed. And then it took this new technology to actually make it kind of eventually adopted. So I just sort of feel there's this weird feeling of history repeating itself or taking forever to repeat itself. Because, there was this 10-year period where there were no new banks in the US, no new bank charters, right?
I was going to say, my understanding of, narrow banking from when it was originally proposed is a little bit different. So the interpretation I always had was that, a narrow bank is one that would park 100% of its deposits at the Federal Reserve at the discount window and maintain full 100% liquidity, period. Just say, we don't need any investment analysts or loan officers. 100% of it just goes to the Fed and takes whatever they're going to give us. Turn around, take 10, 25 basis points or whatever off the top and pay that rate variably to all the depositors. And there are no other services. It would basically be a wrapper around the Fed in a lot of ways.
Yeah, it's a full reserve bank.
It's a full reserve bank with 100% liquidity, zero liquidity risk. And like you could do this hypothetically with like 12 employees and scale to any amount of size. And people hated the idea of a narrow bank because it would compete with the existing,
Well, you say people didn't like it. The Fed didn't like it. People
yes,
loved
the Fed. Yes, people loved it, but the Fed didn't like it for a lot of reasons. But it would compete with the existing, fractional reserve and commercial banking sector, right? That increases the money supply through loans as opposed to just parking it at the Fed, right? And they thought that the radical simplification would also dry up liquidity for mortgages and for things that are good. And that narrow banks would.
Here's the way that I would describe why the Fed rejected the concept of a narrow bank is that it restricts the Fed's ability to directly intervene on the money supply, right? Because it's not as though nobody would give mortgages anymore. It's that it would move to private lenders, right? Private lenders would start offering rates on mortgages because ultimately, people want you can borrow money for fucking anything in principle, right? And house is obviously good collateral in America, so. But once the market moves into private lenders, the Fed loses a lot of the mechanism to be able to directly intervene on the basic expansion of the money supply. So,
well, no, if anything, they'd have more ability to intervene because the lever of what is the overnight rate changes everything for everybody everywhere. If there's more,
right, but they also have the reserve ratio, right? The reserve ratio is a second lever. That's a very powerful lever that can instantly,
changes the money multiplier.
Increasing rates or decreasing rates. Obviously, you've got the zero lower bound, which I guess technically you can cross, but the U.S. is not to go into negative interest rates. But second, it's just a much slower mechanism to go into the market than now as banks you can loan out everything that you have in reserves and just go hog wild. That can change much faster.
Which brings us back to the Genius Act, and Tarun was saying that stablecoins are like narrow banks, although I would say with this legislation are not like narrow banks, but.
Well, no, I think what he's saying is that the Stable Act in particular, because it doesn't allow yield, right? Why aren't they allowing yield in the Stable Act? Presumably because they don't want it to compete with commercial central banks.
I thought Tarun was saying that makes it more like a narrow bank, but the whole point of a narrow bank is you pay people incredible rates and it's fully liquid.
Well, so I think what he's implying is that you could create a narrow bank using a stablecoin if you don't disallow paying yield.
Correct.
Right. So under the Stable Act, you cannot really create a narrow bank that would compete with commercial banks. But under the Genius Act, you could. You could basically have a stablecoin that just holds a bunch of treasuries and pays back all the treasury yield minus 20 bips or whatever, and that ends up becoming a really easy business. And you could argue that's kind of what Tether is. Obviously they don't pay yield, but if they did, it's an incredible business model. It's very labor efficient. They have 90 people or something over the $100 billion plus that they hold in assets. So that's a pretty damn good business. I think there is something there that this is kind of a backdoor way to reintroduce the concept of a narrow bank, but in a way that we're a little bit more comfortable with and has broader geopolitical advantages. Whereas a narrow bank would really only harm commercial banks without having any offsetting benefit to the US dollar or to, the internationalization of the dollar as it's often called. Right? The advantage of stablecoins is that, even if you do have something that competes with commercial banks, it also increases the overall TAM for the dollar by exporting it internationally. Narrow banks don't really do that. It's purely zero sum between commercial banks and narrow banks. So I think from a policy perspective, that's the reason why you might look at it differently for stablecoins. But I do agree with you, Tarun, that it's very likely that when you get central bankers and or even banking executives looking at this thing, they're kind of actually, we should only have people with banking licenses being allowed to issue stablecoins, because at the end of the day, this is kind of regulatory capture 101. Is you really want to make it so that a smaller and smaller number of players can capture this market if you're a bank. So, Robert, given your time in DC, what's your read on how the final bill is going to go? Do you think it's going to look more like Genius Act or look more like the Stable Act? More restrictive or less restrictive?
I think it's going to be less restrictive with the exception of yield. I think the commercial banking sector as it currently exists doesn't want to see yield on stablecoins. And I think with that exception, it'll be a looser bill, but with the one caveat being no yield on stablecoins. That's my guess if I had to just put a line in the sand.
Right. And honestly, it is one of the weird rackets in banking that, like, I have a Chase bank account, and I'm like, why doesn't my cash automatically get swept into money markets and then get drawn?
Why am I
the
earning
moment
one
that I want to
basis
spend
point?
it? Right, exactly. Why is it like purely a function of my laziness that my money, this is so trivial to do if they would just do it for me. But if you don't do it yourself, and a lot of people don't do it themselves, your cash is just sitting there. I think this is also true for brokerage accounts, that a lot of people just have their money sitting there doing nothing. And there's one button to move it into the money market. And a lot of people just don't. And so the brokerage just makes shitloads of money on people just kind of being lazy with their cash that they haven't swept yet.
Yeah, I mean, brokers make money primarily off of interest nowadays.
There was a FTC, I guess, lawsuit or investigation to Citi. I don't know if you read about this, where they had two different savings products that were basically the same name, but one was this 1 BIP and one was
Matt Levine wrote about
rate.
this.
Yeah, and then I think actually the new Trump admin dropped that, so we'll never find out what happened. But Citi gets investigated, and the stables get away with it. So
yeah. You can't lower the rate for new customers very easily, but you can roll out a second product that goes up, and all of the old customers were left at the interest rate that didn't go up.
Well, but ironically, if you think of this as a cash account, right? Stablecoins, even if you're not sharing yield, if you're not getting yield on your Tether or your USDC, just lending it in the market gives you reasonably high yield. Not, it's not necessarily treasury rates, but it's pretty good. I don't know what it is right now. Is it above or below treasuries?
I think it's
for stables,
5-6%. But I mean, you can also.
Okay.
I think the idea with Neurobank is you can choose, instead of bundling all this together, you can unbundle it and choose your risk profile. You can put it into private credit. You can put it into tokenized treasuries. You can do whatever you want, versus having a single entity kind of do it for you. So you can go and do that if people so desire.
Yeah, that makes sense. But if there's a reason why stablecoins do win and drain deposits out of the banking system, my guess is that would be the reason why, is that your cash is always earning a yield regardless of how lazy you are. So anyway. All right, we're up on time. So we got to wrap, but we will be back next week. Thank you, everybody.
Thanks, everybody.
See ya.